MicroStrategy, a business intelligence and software company, has distinguished itself not just in its primary business, but also as the largest publicly traded corporate holder of Bitcoin. Under the leadership of Michael Saylor, the company has invested more than $5 billion in Bitcoin, an unprecedented move that has sparked widespread discussion in the financial world. This substantial investment in a volatile and still somewhat controversial asset has placed MicroStrategy at the forefront of the ongoing debate over Bitcoin's role in the global economy. Today, we're joined by Michael Saylor, who serves as the chairman and CEO of MicroStrategy, to provide insights into the company's strategic decision to embrace Bitcoin and his broader views on the cryptocurrency's future in the financial landscape. The debate surrounding Bitcoin safe haven, inflation hedge, or speculative asset. In the world of finance, the classification of Bitcoin has been a subject of debate. Some view it as a safe haven asset, similar to gold, that can protect against economic downturns and inflation. Others see it as an inflation hedge, offering a store of value in a world where fiat currencies can be devalued by government policies. Yet, there are those who dismiss it as a speculative asset, one that's prone to massive price swings and driven more by hype than by intrinsic value. Michael Saylor addresses this debate by offering a clear and thought-provoking perspective. Bitcoin, in his view, is not merely a speculative tool, but rather a perfected form of digital gold and digital property. Saylor suggests that many who trade Bitcoin today do so without a deep understanding of its value, treating it as just another risk asset or tech stock. However, those who invest the time to thoroughly study the technology behind Bitcoin recognize its unique properties as a secure, decentralized store of value. To Saylor, Bitcoin is the ultimate risk-off asset, designed to withstand the test of time and inflationary pressures, much like gold has for centuries. Unlike fiat currencies that are subject to inflationary policies by central banks, Bitcoin is designed with a fixed supply of 21 million coins, ensuring scarcity and limiting the potential for devaluation. Bitcoin as a superior form of digital property. One of the key concepts that Michael Saylor emphasizes is that Bitcoin is best understood not as a currency, but as digital property. The Internal Revenue Service, IRS, in the United States has classified Bitcoin as property, which reinforces this notion. Saylor argues that the best approach for investors is to buy and hold large amounts of Bitcoin for extended periods, similar to how one would invest in a valuable building or land. Saylor makes the case that Bitcoin is superior to traditional forms of property like gold and real estate. While gold has long been considered a safe store of value, its supply is not truly finite. Gold mining continues to introduce new supply, which can dilute its value over time. Additionally, gold is centralized in terms of its storage and distribution, requiring physical handling and significant costs for safekeeping. On the other hand, real estate, while offering the potential for generating rent, is subject to geographic limitations, regulatory hurdles, and physical deterioration. Bitcoin, in contrast, exists purely in the digital realm. It can be transferred globally at the speed of light, and through various financial mechanisms, can effectively generate digital rent by lending or staking it on decentralized platforms. For large-scale investors, this makes Bitcoin an attractive asset, particularly in a world where traditional investments like bonds and real estate may not offer the same level of return or flexibility. Saylor draws the analogy of holding Bitcoin to owning a billion-dollar building, but without the physical constraints or vulnerabilities that come with real-world property. Its digital nature means it can be accessed and utilized from anywhere on Earth, offering unmatched liquidity and utility compared to its physical counterparts. One of the concerns often raised about Bitcoin is its potential use by nation-states, particularly in circumventing economic sanctions. In the context of global conflicts, such as the sanctions placed on Russia, there is speculation about whether Bitcoin or other cryptocurrencies could be used by such countries to evade financial restrictions imposed by other governments. However, Michael Saylor downplays these concerns, arguing that Bitcoin is not currently being utilized by nation-states like Russia to bypass sanctions. While Bitcoin offers financial independence, Saylor points out that its primary users are working-class individuals, particularly in regions where traditional banking services are either unavailable or unreliable. For these individuals, Bitcoin represents a way to protect their savings from hyperinflation or currency devaluation. In countries where the local currency is unstable, or where banking systems are corrupt or non-functional, Bitcoin becomes a lifeline, allowing individuals to store their wealth securely outside of the government's control. Saylor predicts that while nation-states may eventually adopt crypto technologies at a larger scale, this shift is still many years away. For now, Bitcoin's primary use case is as a financial refuge for ordinary people, particularly in developing economies where access to banking services and stable currencies is limited. For millions, Bitcoin is not just an investment or speculative asset. It is a tool for financial survival in the face of unstable governments and economic systems. Regulation and the future of Bitcoin adoption. At the time of the interview, Bitcoin's price hovers around $40,000, reflecting the volatility and uncertainty that has characterized its market since inception. However, Saylor is optimistic that increased regulatory clarity will pave the way for more widespread adoption of Bitcoin, particularly among institutional investors. Currently, the world of cryptocurrency is often seen as a regulatory gray area, with governments and financial institutions struggling to define and regulate different types of digital assets. There is confusion between cryptocurrencies, securities, platforms, and properties. However, Saylor believes that as regulators start to draw clearer distinctions between these categories, institutional investors will gain more confidence in Bitcoin as a legitimate asset class. Institutional investors, including pension funds, insurance companies, and large corporations, control billions or even trillions of dollars in capital. Many of these investors have been hesitant to allocate large sums to Bitcoin due to regulatory uncertainties. Saylor anticipates that once these uncertainties are addressed, institutional capital will flow into Bitcoin at an accelerated pace, driving up both demand and price. He believes that the arrival of regulatory frameworks will act as a green light for these investors, allowing them to take progressively larger positions in Bitcoin without fear of legal repercussions or regulatory risks. Demand for stablecoins and the future of digital finance. Looking beyond Bitcoin, Michael Saylor highlights the growing demand for two specific types of digital assets: crypto dollars, particularly stablecoins pegged to the US dollar, and Bitcoin as a store of value. Stablecoins have gained popularity because they offer the stability of traditional fiat currencies, like the US dollar, while retaining the advantages of cryptocurrency, such as global accessibility, 24/7 availability, and lower transaction costs. Saylor suggests that the demand for stablecoins is immense, with the potential for trillions of dollars in global demand. In many parts of the world, people prefer to hold US dollars over their local currencies due to concerns about inflation or political instability. By having access to US dollar-backed stablecoins on their mobile phones, individuals can store and spend money without relying on traditional banking systems, which may be prone to corruption, inefficiency, or excessive fees. In this vision of the future, stablecoins represent the ideal medium of exchange for daily transactions, functioning as a digital checking account. Bitcoin, on the other hand, serves as a savings account or store of value, akin to digital property. Just as individuals might keep a portion of their wealth in cash for daily expenses, and the rest in assets like real estate or gold for long-term security, they would use stablecoins for day-to-day transactions and Bitcoin for long-term wealth preservation. Conclusion: the long-term outlook for Bitcoin and digital assets. As the interview concludes, Michael Saylor reiterates his bullish stance on Bitcoin and its future as a dominant form of digital property. He foresees a future where Bitcoin is widely adopted by institutions and individuals alike, thanks to its unique properties and the regulatory clarity that will come with time. While the world continues to grapple with the implications of cryptocurrencies, Saylor is confident that Bitcoin's fixed supply, decentralized nature, and superior portability will ensure its place as a valuable and lasting asset. In the broader landscape of digital finance, Saylor envisions a system where stablecoins and Bitcoin complement each other, fulfilling different roles within the financial ecosystem. Stablecoins will serve as the primary means of exchange, while Bitcoin will function as a reliable store of value. Together, these digital assets have the potential to reshape the global financial system, offering greater financial inclusion, security, and efficiency to people around the world. With this optimistic view, Michael Saylor leaves us with the impression that the era of digital property is just beginning, and that Bitcoin, along with other digital assets, will play a pivotal role in shaping the future of global finance.